During the month of April, while most traders were complaining about news, volatility, and choppy markets, I had some of the cleanest setups I've seen in the market and made some of the best gains in a single trade from the volatility and embracing that volatility. In the month of April, I made just over $50,000, and I'm planning to close out the month with over $80,000 on the month. And no, this isn't just one lucky gamble of a trade that made me all these profits. It was consistency and knowing when to trade the markets, when to sit out, and when to wait for the right opportunities and take advantage of those opportunities when they present themselves. Too many traders will make a ton of money and then lose everything right away. Your goal should be to make money and protect money at the same time, because money that's not taken to the bank at the end of the day is not yours yet. The way I was able to do this was through calculated execution on my setups that I've been practicing for the last 6 years. Nothing comes overnight. I wasn't just able to get from like a 2K account all the way to 6 figures. It took me time to develop the skill, build my account, and get to the point that I am at today. The setups that I traded this month are the same setups I've taught my students that have helped them going from, not able to be consistently profitable to making 4, 5, and even 6-figure months. Today, I'm going to break down exactly how I did it and how you can too, replicating this strategy. Before I break down exactly how I pulled this off, let me be clear. This isn't some sort of get rich quick scheme. It's not about turning $100 into $1 million overnight. This isn't some sort of magical indicator or pattern that nobody knows about. It's just about hard work, dedication, and following a simple strategy that is going to keep things basic and repeatable over a long period of time. The truth is that professional traders aren't mastering 15 different indicators and 20 different strategies and trading a million different tickers. They're focusing on the most simplistic setups because those are the ones that you could scale in the long run and be able to kind of do your whole trading career. At the end of the day, we want to turn this into a career, not a hobby where we can get rich quick. And I'm about to show you exactly how I approach the markets, the same approach that has allowed me to build a multi-6-figure portfolio at the age of 23 years old. First, let me show you exactly what was going on in the markets at the beginning of the month that led me to take the trades that I took. So first of all, we want to figure out what the trend of the market is whenever we're looking at stocks. The easiest way to do this is to use something called the exponential moving averages. They're going to be these 3 lines right here that basically tell us what the momentum in the markets look like. If the markets are below the moving averages like so, and the moving averages cross one under the other on the daily time frame, that means we are in a daily downtrend. So what you should expect is every single pop is likely to get sold, and continuation to the downside is likely when things do set up for that continuation. However, that doesn't mean every single setup you should be taking to the downside, but the trend is going to be your friend generally. And if things are setting up to the downside, we do want to play them to the downside because the trend and the momentum is going to help you carry through those trades and hit the best winners. You're not going to be able to have huge winners if you're trading against the momentum of the market, but we're going to get into an overextended trade, which is what I'm going to talk about and something that I took advantage. When the markets do eventually get overextended from the moving averages, that is when you could play a counter trend move for a mean reversion trade, which is what I did here later on in the month. But at the beginning of the month, I was just easily trading the trend as we were making lower highs and as the markets were rejecting these levels and setting up. You only want to trade the counter trend whenever the market is giving you clues that it's going to start reversing or that it's too extended to one direction. So you could see in this case right here, we were a little bit extended to the downside after getting about 5% away from the moving averages. So you can see this is the 8 EMA right here. We're about 12% away from the moving averages, meaning the markets were extended to the downside, and it's likely that you were going to get a big snapback rally, especially since we were coming off of very important levels. So I always like to analyze the markets first. I'm on QQQ right now, which is the tech index, but you could use the S&P 500 or SPY, and you could also look at the Dow and IWM to give you kind of a better idea on what the markets are doing. That way, you're going to be trading within the trend. It's so much easier to trade the trend than it is to trade against the trend. If you feel like you lack a lot of follow through between your setups, it's probably because you're trading against the trend and you're trying to play against the momentum of the market, which is ill-advised. Now, the difference between me and most traders is a lot of traders take just random setups. They try to trade every single day. What I do is wait for something called a setup. A setup has to be present for me to take a trade. And what a setup looks like is if you're in a downtrend, you're looking for downside continuation, meaning every single time the stock gets tight or it sets up within a pattern, you're looking for the continuation of that pattern to a specific specific area. For example, if a stock is going down, we're looking for a continuation pattern to set up or a move to the downside. If a stock is going up, we look for it to go sideways and then set up for a continuation move to the upside. This is like the most simple type of pattern within the market, because this is how the markets move. You don't want to overcomplicate it. The markets move within these patterns. They move kind of like in staircases until you reverse the trend, and then the move happens the other way if that is where the market wants to go. Remember, trading isn't about taking every single setup out there. It's about finding the best setups and executing the trades that fit your checklist or whichever kind of criteria that you have. That way you know you're in the best trades, and you have rules and you have setups for these trades. So my exact strategy is looking for a big move to the downside if we're breaking into a downtrend, so the markets are below the moving averages, and then for stocks to set up for continuation moves. So you could see, for example, right here within the market, we had this test of this low right here. Once we broke that level, this is where I got short, because the market went lower under the moving averages. It set up in a 2-day flag like this. It broke down out of that 2-day flag and under a key level, and then it started a very deep downtrend. So I played downside moves here as the stock market was moving down. Now, as we were starting to bounce, right, at this point, everyone is looking to get into a trade, but I was staying patient, right? There wasn't really a lot of setups. Market was going sideways. When the market goes sideways, as an option trader, we usually try to avoid this type of condition within the market, because that makes it super hard for us to have any follow through on our contract, specifically because options have time decay. So it's going to be much harder for us to be able to hold longer when things are going sideways. So I took this time off right here, and I waited for the market to set up and really give me some sort of idea on where the trend is going to continue. Once I started noticing that this bear flag was setting up and we broke these lows right here, this is when I started to realize that this is going to be a big downside continuation. So you could see this day right here, we had a move down, we bounced a little bit, set up another bear flag, and then the next few days was a big continuation to the downside. So the bulk of the money that I made over the month of April was trading this move right here. This move to the downside, I caught only 2 trades, right? Again, you can have 10 trades on at a single time, all with a very small size, and catch a bunch of different stocks. Yes, right? However, what if the market goes against you? It's going to be so much harder to get out of all those positions, have the bias flip to be able to, change your position and trade the other way if the stocks are going against you. If you only have a few positions on at a time, specifically 1 or 2, it's going to be much easier to manage them. Plus, you're going to have much more conviction on 1 or 2 setups than you are on like 10 setups in the market, right? So I like to focus on the best setups out there and only focus on like 1, 2, 3 maximum, maybe 4 if the market's really hot in a trend stocks. That way I know exactly the names that I'm in. I have the conviction to hold them into my targets, and I'm not going to sell too early. I'm not going to deviate from my plan, and I'm not going to get emotional. So once the market started to break down out of this bear flag, I ended up catching a nice continuation move to the downside. I bought puts on this day right here. We had a nice continuation the next 2 days, and this is where the bulk of the money in the beginning of the month was made. And that's when I started to notice that the markets were getting a little bit too overextended. If you draw a trend line from the highs, you could see we were down 24% off the highs within the last few weeks, coming into a very important level. There wasn't, a ton of volume into the lows yet. So what I was looking for was volume like so off the lows, which is what we got. This is when I started buying back stocks, because a lot of people were selling here, right? We had a lot of fear into the lows. I shorted this move down, but once we got down to these lows right here, had an idea that we'd probably reverse a little bit and find an overextension move off of this spot. And I'll explain exactly how I did it in the trades that I took to be able to capture these moves up. Let's get into the trades. So the first trade that I took on the month was on the 1st of the month. This was a swing on the ticker Johnson & Johnson. The setup on this one was a beautiful daily flag on the daily time frame, and I'll show you guys that right here. So this is the setup that I was looking at on the ticker Johnson & Johnson. Now, the markets at this point were moving lower. However, we have to understand that defensive stocks like Johnson & Johnson, healthcare stocks that are more consumer cyclicals, are going to be stronger when the market is going down, specifically tech stocks. So a lot of defensive stocks were getting bought up. You could see as the market was moving down, this stock was actually moving up. So sometimes there is opportunities to take stocks to the long side. Now, for this one, unfortunately, I got hit with very bad news, right? So I'm not only going to be sharing the beautiful winners, just like a lot of people do, I'm going to show you the losers, specifically big losers, and tell you that it does happen, right? It can happen and it does happen. Sometimes you will be caught overnight in bad news. So I trade with a 6-figure account, but you could see my position sizing was only $3,000. Why? Because I'm not full porting every single trade, because something like this can happen. So you could see I ended up entering this trade as the stock broke out over these highs. I trade breakouts, right? I look for stocks to break out over important levels with a lot of volume, and then I look for continuation into new highs. So my strategy for this trade was to move all the way up into these highs right here, but it ended up gapping down the night after. And in the morning, obviously, I had to sell this one for a very big loss. I lost 75% on this trade, which is a huge, huge loser, right? A lot of people at this point would be second guessing themselves, second guessing their strategies, asking if trading is for them. It doesn't matter, right? A loss is a loss. Sometimes you're going to have bad probability. Sometimes you're going to have bad luck. But all that matters is getting right back up and focusing on your system. Did you follow your system? Did you follow your rules? Did we oversize or did we size correctly? So we sized correctly on this trade. We avoided an absolutely huge loss by sizing too big. Now we have to move on to the next one, take it on the chin and understand what could we have possibly done better. So in this situation, I don't honestly think there was really much I could have done better. I stuck to my plan. I sold this right at the open. And that's all that happened, right? Sometimes there's going to be bad news. Sometimes there's going to be bad luck. The setup was there. It's everything I looked for. It just didn't go my way. Now we move on to the next trade. So the next trade I took was that short that I was showing you guys in the market. Whenever we broke down and we had that kind of 3-day follow through to the downside, this was a huge trade. Now, you could see the difference between the winner and the loser that I had. This was a $10,000 winner off of $5,000 versus a $2,500 loser, right? My goal is always to try to keep my losers as small as possible and my winners bigger, even if sometimes I get unfortunate news that goes against me. I'm trying to always be in very, very small positions and try to flip those positions by having correct risk management and holding my positions for a long period of time to capture the move. So what I was looking for this trade was a break of these lows. We were setting up in a very tight bear flag. You could see the trend was clearly to the downside. And as the stock broke these lows with a ton of volume, that is where I took the trade. I was risking the highs. I got in near the lows and I was looking to target into these lows right here. So this was the risk. That was the reward. This was almost a 6 risk reward trade. If you look at the hourly, I'll show you exactly where I entered. I entered right here at the end of the day when we broke out under the lows of this bear flag right here. So you could see the first breakdown under that level. Then we had a continuation lower. So as the chart was breaking these lows right here, we had a move under this big bear flag. I entered the trade right there. And then the next day you could see we ended up gapping down and then I sold some right there for my first trim. Now, the way that I use targets is I look at previous price action on the daily time frame and I look for levels to sell my position at. So for example, if I enter the trade right here, for example, this is my entry. I look for the trade to potentially hit at least a 1.5 risk reward, meaning my target needs to be an important level. So for this trade right here, I use this level right here, and then I use this level right here, which you could see we ended up hitting there at the lows, which was my second TP. So going back down to the hourly, you could see I ended up, trimming some here during this day right here. My first trim was 9.50. Now my trim strategy is if I have 10 contracts or if I have 8 contracts, what I'm doing is I'm trimming in fourths. So I set 3 targets for myself on the trade and then I trim in fourths, meaning the first trim that I take is 25% of the position and I take that off at the first trim. Then after I hit the second TP, I take 25% of the position, meaning I have 50% left. And when I hit the third target, I take another 25% off and then I'm left with something called a runner. So I never sell out of my full position because a big part of my strategy is being able to catch big winners. And if you sell your whole position right away after a first target, you're not going to be able to catch continuation moves and big winners. What's going to happen is the trade is going to continue to run and you're not in that position because you sold the whole position. So that's why it's super important to have a trimming strategy and do it the right way. So this trade, I ended up taking the rest off into my third target right here. My stops were set to break even. And then on the runner's position, I ended up getting stopped out break even later on. But you could see this trade was absolutely textbook, playing within the trend of the market and catching this big move to the downside. Beautiful trade. The risk reward on this one was a 3-to-1 at the end for the realized risk reward. A 216% return, $5,000 position, grossed me $10,000. I think this was one of my best trades of the week. And like I said, again, you don't need to have, a million trades on. You could have one trade that makes you 200% and be set for the week. The issue is that people think that you need to, have 200% trades every single day, which is highly unlikely because sometimes the market just doesn't move a lot, right? It's in a consolidation period and you don't get big moves during that time. So that is going to be a recap of the first week. The second week was the biggest week that I had. So this is where a lot of the big trades that I took were. You could see right here, I closed out the rest of the Adobe on the Monday, which is why you could see that we made about $6,000 on that day. And then I took a small trade on Celsius. This was just a very, very small winner on this trade right here. The reason why this was such a small winner is because the markets really weren't moving much. So for this trade, what I was looking at was a daily breakout again, right? Again, every single trade that I take starts on the daily time frame. So I was watching for this to break out of this kind of daily flag right here, but it didn't end up getting much follow through. If you go to the 15-minute time frame, we could see that a little bit more. As it was breaking out of this 15-minute flag, I got long right here. I was targeting these highs, but I ended up not seeing the market make that much follow through. So I trimmed a little bit up here, right? I sold about 3 at 2.34, and then the rest I got stopped out at break even, because what I do when I hit my first target or when I take my first trim is set my stop back to break even. So again, this happens sometimes you'll get stopped out, the trade will come back down, right? But you're managing your risk. So even though I only made 6%, which is basically break even, still made $90, which again is not a huge amount of money, but I'm staying consistent. I followed my plan. I didn't over leverage. I didn't over risk. I didn't just say, I need to make $1,000 on this trade, or else I can't go, back to my desk or whatever like that. You need to have realistic approaches, and you have to understand that sometimes a trade will be break even. Sometimes you will also have losses, right? And that's okay, and we have to accept that. So for this trade, I was looking for a daily breakout on to the upside. The reason why I was focusing to the upside is because you could see at that point, QQQ is very overextended into the support level. So I know I said earlier that I trade the trend. However, sometimes when the markets are very extended from the moving averages, that is going to be the time when you can potentially take a counter trend trade into a big support level. This is a very low risk idea with very high, reward. If you get a good continuation to the upside like we did here, you're only risking these lows for a very big potential reward. So it's very low risk. It's not very high probability, but when the markets are overextended, the probability does get higher, because the more extended the market is from the moving averages, the more likely it's going to create something called a mean reversion. And a mean reversion means when the stock is getting very extended from its mean or its moving averages, and then it snaps back to the moving averages, exactly like we did here, which is what I traded. So that is something you could learn to do. If you start noticing that the market gets very extended, you could look for a pullback into the mean, which would be the moving averages. Another great example of this setup would be something that occurred on gold. You could see gold has been gapping up night over night until it got very extended from the moving averages, and then it ended up coming down and retesting the moving average again, showing you that it's a mean reversion trade. Now, these trades, you don't want to, go all the way, take them all the way down. They're just a quicker trade for a mean reversion, meaning once you hit the moving averages, that's where your target is going to be. You're not going to look to get greedy on this. Obviously, it can continue to go higher or go lower, depending on if you're taking a short or a long. However, that is the bulk of the trade, looking to take it back into the moving averages. And that's exactly what we saw here on the tech index and QQQ. And I'll go over exactly how I traded this as well. On to the next trade that I took. This was on the ticker Apple. This was one of the most unfortunate trades that I've had in a while. This was a very high conviction, a call that I took on Apple. So I took this one at the lows looking for a bounce back up. You could see this was the 620 calls for 200 call for 620, which is June 20th, looking for a big swing trade on this because I thought the markets were going to have some sort of, pause on tariffs. Specifically China news, which we ended up getting, but I did sell this one for a loss. So I'll show you guys the setup here on the daily. What I was looking for on the daily was that mean reversion idea. So I got in as it got overextended to the downside. You could see that it ended up, being very, very extended lower. We bounced a little bit on Monday, but then the next day it kind of made a new low. What I was looking at for this one specifically was a double bottom. This day right here, we ended up bouncing, and then right here we came all the way back down to this 174 level. I took the trade off the potential double bottom right here, and I risked the low, right? My risk reward on this one was very, very tight. So I was risking these lows right here. So I got long right there, and I was risking these lows right here. and I was looking for a trade all the way back to the highs, which would have been a 2.3 risk to reward. You could see it ends up playing out almost perfectly, but I got stopped out under this low right here. So into the end of the day, I get stopped out, but this could have been a 500% trade. If you look at Apple today, you could see it ended up running all the way back into the highs and making an absolutely huge move up. And this again shows you that sometimes you will get stopped out. Sometimes the markets aren't going to be in your favor, but it's all about sticking to the plan, because I only took a 16% loss on this. And yes, I could have made 500%, but would I rather manage my risk and be able to do this over a long period of time, or sometimes get lucky and have big wins, but eventually end up losing everything because my risk management is not in check? I would always choose having proper risk management and being able to do this the correct way. So for this trade, obviously we had a very, very big move the other way. And I got stopped out for a small amount, but that's a part of trading, showing you the good, showing you the ugly, and then moving on to the next trade. So on this day, I took Coin and then Tesla, and you could see these two made me an absolutely insane amount of money. So for Tesla, I made $27,000. On the coin trade, I made $12,000. So we'll start with this coin trade right here. This was off of that big move that I was saying on the extension from the downside. So we had a very, very big move in the markets off the lows because of the tariff pause. So if you look at QQQ, you could see right here, we had news. The tariffs got paused on a lot of countries other than China, on every other country other than China. And we had a big move on QQQ. The markets reacted beautifully, made a big move through this spot. What I was looking at for this trade was we had an overextension from the moving averages, right? So we had a double bottom here on the markets at this key level. We were very extended from the moving averages. So I was looking for a mean reversion trade up to this level right here. And the markets were breaking over a key level, which was this resistance right here. You could see every single time we rejected this level, we got to move down. Rejected this level, we got to move down. So if you break above, you know there's a good chance markets are going to continue and follow through. So that's the exact setup that I was looking at on Coinbase. You could see right here was a chart on Coinbase. You had a higher low that was being made. You had a potential kind of like double bottom here at the lows. You had clear resistance right here. And what ended up happening was the stock broke this level with a ton of volume. I entered long right here. My stop loss was at the candle's low at 164. I ended up catching this all the way up to 183, which was an absolutely massive trade, about 150 to 200% on this trade. Catching it in the gap right here, and I was targeting previous resistance. You always want to target previous resistance. If you don't target a resistance level, what's going to happen is market is going to reject at a resistance level, and you're not going to be able to catch the bulk of the move because you're going to reject right here. You can't just randomly say, I want the stock to go up to a specific number, because you don't know if that's going to be a big key level, right? So you need to mark out key levels on the stock and see where the stock used to reject, right? If that's the level that it rejected, if it gets above, that's probably where it's going to continue higher. But if it stays below, it's probably going to reject and move lower. So we want to at least take some profits at that level. And that's exactly what I did. So going back to TradeZella, you can see this is the trade right here. It cost me $12,000 on this trade. I made about 100% on this whole trade right here. It could have been more, but I ended up getting stopped out break even. And I rolled over this trade later on, taking a little bit more time. But you could see the daily setup that I was looking at. We had that double bottom right there. And then on the smaller time frames, you could see exactly when I was able to take the trade on this one, right as it broke this key level right here. And then I ended up taking this one all the way up into the highs, and then catching a huge winner on this one. I got stopped out break even on some of these later on, but the trade was absolutely a beautiful one. So on the coin trade here, you can see on the 15-minute time frame, as the stock was breaking this really important resistance level right here, I ended up taking the trade. Stop went to the low of this candle that I took the trade on. Whenever I take a trade, I look for a 5-minute close over the specific candle that I'm looking to trade. So you could see, for example, this is the level right here. The moment it closes above on the 5-minute time frame is when I take the trade. Stop goes to the low of that candle that broke that specific level. You can see I ended up taking off the trade into the end of the day. I took one trim right here, and then I ended up getting stopped out on the rest at break even. So obviously I could have made more on this one later on. However, I got stopped out break even on the rest, which again is a part of the process. Sometimes you get stopped out at break even or lower, and that's a part of the process. And sometimes you'll get stopped out break even, or you'll get stopped out for a small profit on the rest of your position. But that's why you want to lock in profits and have a systematic approach to your trading. So you want to take profits as the stock gets into your resistance levels and into your targets. And you want to also manage your risk by moving your stop up higher and higher and higher as you get closer to more targets. That way, the stock doesn't come all the way back down to your level and wipe out all your profits. Next trade that I took was very similar to the Coinbase one. It was on the ticker Tesla, coming off of this big double bottom. Again, extended away from the moving averages while the markets are bouncing. I saw that news that came out and I looked for a break of the previous day's high. Once that broke, I knew we were going to get a very big move up, specifically because there was a ton of volume. If you go down to the 5-minute time frame, you could see the stock was breaking this level with a ton of volume. So the moment you get a 5-minute close above, that is going to be your entry, and you're looking to target into previous resistance. So the first level was up here, then we had another level up here, and another level up into this gap right here. These were my targets for this trade. Ended up running beautifully on TradeZella. You could see the exact entry that I took right here. As it broke over this level right there on the 5-minute close, ended up running into new highs, trimmed a few times. Again, you trim as you have profits into your take profit levels, and then you move up your stop to break even. So even though I was swinging this one, you could see the next day I ended up getting stopped out break even when the stock comes back down to test the level that I took the trade at. But that's fine, right? Because I was still able to manage a good amount of the position and lock in a bunch of profits. So you can see on this one, I ended up sizing up pretty big. When the markets get tight and when there's a lot of opportunities, this is when you want to size up. You want to size up when the markets are showing you that there's going to be a big move, right? We don't want to be stuck in price action where things just go sideways with options. We want to be in very big positions. So for this trade, I did end up sizing up. Usually my trades are about 12 to 15,000 per trade. For this one, I took almost 30K on this trade, but it ended up being an absolute beauty. 100% on this one into the trims. And obviously it could have been even more if I didn't end up getting stopped out break even on the rest of it, but it ended up being a beautiful trade that made me $27,000 on the day. Now, the next day I ended up opening something called a rollover trade on the ticker coin. What this means is whenever you don't have enough time for your contract and you're already in a position, you enter something called a rollover. So let's say I have like the expiration of April 17th, but I want to hold the position for longer and April 17th is starting to approach. What I do is something called a rollover trade where I roll over my profits from the original trade and then I buy a new option for farther out. So for example, for this one, I bought the 200 call for May 16th and the original position I had was April 17 calls for the 180 strike. So I basically end up taking more time and I take a strike that's farther out in the money to catch the continuation for the trade. You could see for this one, I ended up catching a decent 20% move, but then I ended up getting stopped out on the rest at break even. So I rolled it over on this day right here, ended up coming down a little bit into this low right here, but for this trade was my stop loss was right at this low. So you could see I ended up holding almost like beautifully, right? And then as we kind of pushed up into these highs right here, I trimmed a little bit, and then here I ended up getting stopped out break even. So not a huge trade, but still a very nice one, rolling over my profits. This is something I like to do a lot, and a huge trade that I caught on Tesla last year in 2024 when it was having its crazy run was I continue to roll over my contracts. And usually what I like to do with this is only risk my profits, meaning I usually let the contracts go to zero because I'm only risking the profits from the original play. So I'm looking to maximize the amount of profits that I can make. Obviously, I want the stock to continue to go in the direction of the trend to be able to maximize the profits. And when it does, it pays off absolutely huge. If you lose, worst comes to worst, the only thing you lose is the profits that you've made. So you manage your risk by only using a portion of your profits on the trade. The next trade that I took on April 10th was on the ticker app. This one was a counter trend trade, and this is probably why I lost out on the trade and why reviewing your trades is so important. You want to go back and see exactly what you did wrong. That way you avoid doing this exact mistake. So what I was looking at for this trade was a break over this trend line right here, and for the price to get over the 21 EMA to be able to catch it into the 50 EMA for a quick move up. Now, what I obviously didn't realize, or what I did know, but obviously I didn't take into account, was the fact that the markets are in a downtrend and it's going to be much harder to have follow through when things are moving to the downside. So you can see on the 15-minute, it set up a beautiful flag. And what I was looking at was for this to break out of this wedge right here. It ended up kind of trying to pop through, right? But I ended up getting obviously trapped here into the highs, and I sold this one for a pretty good amount of a loss. I think it was about 10 or 20%. Because it failed to continue to break out higher. But again, you could see that ends up saving me. It ends up going lower here, making much new lows into 220. And this is why stop losses are so important, because if you take a trade and you ended up getting stopped out, here, but later on it just runs all the way down, you're going to have a huge loss. A stop loss keeps you in check and it manages your risk. And as a trader, that's the most important thing to do. So going on TradeZella, you could see the trade that I tried to take. This was a hourly breakout right here. I entered as the stock was breaking out, but you could see I kind of got trapped a little bit. We made a long wick up here into the highs. I was using the hourly time frame for this. On the 15-minute time frame, you could see it broke out, but then later it ended up coming back down. And then I took the loss right here when I realized this wasn't going to make new highs. The market was a little bit too low. There really wasn't a good idea for this trade. And I should have probably waited for the daily to be breaking out. And again, even someone who's been trading for so long is able to make mistakes. Even when I've been in the markets for so long, sometimes I still make mistakes. And that's why it's great to review and journal your trade. That way you know what you did right and what you did wrong and how you can improve on the trades that you took. The next trade I took was on the ticker MSTR. This was on April 15th. By this time, the market was already pretty shaky. If I go on the charts, I could show you exactly what I was looking at. So during this time, the markets were trading under the moving average. This is on the S&P 500, and we were kind of struggling to hold this 8 EMA and 21 EMA, giving me kind of an idea that we maybe chop a little bit or don't have much follow through. So whenever I see that, I end up sizing down in the markets no matter what. But the idea on this trade that I took was on Bitcoin. So even though the markets were choppy, you could see Bitcoin was already starting to break out. It was breaking out over this flag right here. It was setting up in a tight kind of like 10-day flag right here. It made a higher low. It was setting up right into the 50 EMA. It broke the 50 EMA with a ton of volume, and then it ran all the way up. So the idea for this one was to catch a crypto-related stock, which MSTR is a crypto-related stock, and play the upward momentum of the crypto-related stocks to the upside. But I wanted to go in light because the overall markets were a little bit weaker. This was the daily setup that I was looking at for the ticker MSTR. We had a big kind of breakout of this wedge right here, and I was looking for continuation out of that spot. Obviously, specifically with Bitcoin moving higher, you could see we reclaimed all the moving averages, which is in line with my rules. If a stock is above the moving averages, I can look to play calls on it, and that's what I was looking at for this name right here to target up into 340. My trigger for this trade was a break over the 318 level, which was the previous high right here. You could see that's where we kind of rejected, and I was looking for us to break over that level. Now going into TradeZella, you could see this on the hourly time frame where I took the entry right on this high right here into the beginning of the day. When we try to kind of break over that high, I tried taking this one to the upside. We go down to the 15-minute, we could see that a little bit better. On the 15-minute, we broke out over the highs. Obviously, the markets were a little bit choppier, which is why it ended up not working out that well. And then as we broke the low of day right here, I ended up selling. So I used a pretty tight stop loss on this one, even though I did end up taking a 33% loss. It was with a lot like smaller size because I was sizing down because the markets were a little bit weaker. But this is one of the only times I traded weekly contracts. I don't usually trade weekly contracts. To me, this was a little bit more of a day trade idea because the markets were a little bit choppy. So when the markets are choppy, I do like to be a little bit quicker, not hold my contracts for as long. But 90% of the times, the trades that I do take are going to be swing trades or longer out trades. Just obviously sometimes if the markets are not cooperating, I have to adapt and shift my strategy to be able to trade whatever the markets are presenting to me. This is my most recent trade that I took on the month so far, and I'm still in this position, but already so far up $5,900 on this position. Have still a pretty decent amount of size on this. And the setup on this one was absolutely beautiful. So going back to Bitcoin, you could see Bitcoin was breaking out of this big flag. We had a big move up, and I needed to take some crypto risk. I had a good feeling that crypto stocks were going to break out because if Bitcoin's breaking out, a lot of stocks like Coinbase, MSTR, Mara, which are crypto miners, are going to probably move with crypto stocks like Bitcoin. This was breaking out of this flag right here, and it was trying to push up to the upside. And the moment I noticed that, I started shifting towards crypto stocks. So I tried MSTR earlier. It didn't really work out that well, but Coin was a beautiful, beautiful play. So this one was setting up in a super tight flag off the 8 EMA. It kind of undercut the moving averages a little bit, and you could see volume was declining the whole time as price was consolidating. These are the exact volume patterns I look for. This is called A+ volume patterns, where you have accumulation off the lows, price goes sideways as it consolidates, and then a ton of volume as price breaks a breakout level. That is where we want to add the position. So I added the position right here as it was breaking that level. Now let's go on the smaller time frame so I can show you the exact trade that I took on it. So on the 15-minute time frame, you could see my exact entry was this high right here. I was using this high to confirm that we were breaking this trend line right here, because if we break the most previous high, that confirms a sequence of higher lows and higher highs, meaning the downtrend is broken on the lower time frames. The moment I noticed that on the smaller time frames, I entered right off the first minute. Now, I usually don't trade the first 5 minutes because that is when the market's a little bit shakier. There's going to be a lot of very volatile moves, so it's going to be harder to time the markets. But whenever there's a very good opportunity like this, I usually try to get in as soon as I can because I saw a ton of volume. It was breaking my level and I need to have conviction or else I'm going to miss the move. And you can see this stock didn't really end up pulling back at all, and it's just been continuing to go up and up and up. Now, I'm not just selling because I'm up on the position. I could just, take my whole position off right now. I'm up about 200% on the contracts, but I'm continuing to hold because I have a good cushion on the trade and I'm very comfortable with the trade and I'm sticking to my targets. So if I go on the daily time frame, I could show you guys the exact targets that I'm looking at. So again, I always trim in thirds. So I pick out 3 targets. My first target was 187, where I took 1 trim. My second target was 200 because that's where the 50 EMA was, where I took a second trim, and then my third target is going to be right here for this gap fill at 215, and I won't sell any before that. Now, however, I do move up my stop loss to break even in case the trade does come back to retest my entry. It's very highly unlikely, but it's always good to manage your risk that way and then keep your stops up at break even after the first trim, but this one's probably going to just continue to run higher. Another confluence that I had on this one was on the weekly time frame. We were setting up in a double bottom. You could see we tested this low twice, bounced off that spot. Last time we bounced off of it, we had a huge run up. This time we bounced off of it, pretty decent move up as well. So my overall risk to reward for this trade was an entry right here and a close below the low for my stop loss. And I'm looking for a target of 215 for the overall trade, which comes out to about a 5 risk to reward. Now, my first TP is at 187. So the first TP risk to reward is about 1.5. There's a pretty big difference because I usually like to target at least a 1.5 risk to reward on the first TP, meaning if my loss is 30% on the options, my winner has to at least be about 40, 45, or 50% winner. That way, if I do get stopped out break even, at least I'm keeping my first trim bigger than the losses that I'm taking. But a lot of times when the stocks do end up following through, I end up collecting a bigger risk reward, usually somewhere around 3 or 5 if it hits obviously my 3 targets. So going into TradeZella, we could see the trade a little bit better. I took the entry right after the breakout of this daily flag right here. Quick pop to the upside. So this is something I like to do on TradeZella, where I go over to the setups tab right here and then I click the exact setup that was taken. That way I can mark it and know exactly which setups are the ones that are working. There's also a very nifty tool in TradeZella that you could use. You can go to playbook over here and you could add this trade to a playbook. So the playbooks that I have is breakout trade with 5-minute candle close. This is usually when we have a trigger above the breakout level that I use. And this is the exact kind of setup that I took on this trade. But I have a few other criteria like continuation setup on lower time frame, daily entry over key trigger, front run trade with breakout confirmation, retest trade of trigger level, and then rollover trade. So I have a few criteria that I put this in. This is going to help you know which playbook is doing the best. If you go to your playbooks, you can actually see which entry models work the best. So this is for the last few months. You could see the breakout trade with 5-minute candle close has worked the best for me. Not in terms of win percentage, but the amount of money that I've actually made on it. Now the retest trades have worked the worst. These ones are the ones that haven't really worked out well for me. And this is something that is super important to note because you want to see which trades have worked the best. But here's what really made the difference for this month: my psychology behind the month. Most traders self-sabotage even if they have the right strategy. They overtrade, they don't take and accept losses, they don't let their winners run, and they cut their winners too early, and they just don't have a good understanding fundamentally of the psychology of trading. During these 30 days in April, I didn't let FOMO take over. I didn't over trade. I didn't leverage trade. I literally only took about 10 trades the whole month, and it's because I stuck to my system and I stuck to looking at the best setups in the market that fit my criteria. The reality is nobody's coming to save you in trading. No mentor, no no friend, no foolproof strategy. The only person that can get you out of where you are right now and get you on the track that you want to be is yourself. You're the only person that has control over that, and you should strive to get better every single day as a trader. Once you realize it's just you versus you as a trader, literally everything changes. You start making confident trading decisions, taking actual calculated risks instead of gambling, and you now have the skills and the tools to be able to make trading an actual income rather than just a hobby that doesn't make you money and just gambling your money away. Now, let me tell you what would have killed these results basically immediately. One is trying to master every single indicator and focusing on a bunch of different strategies. Two is jumping in and out of trades based on other people's opinions, letting news distract you from just looking at price action and deciding what price is going to do based on just the price action. Three is being in the market every single trade and trying to find a bunch of different trades that just don't exist and forcing setups on stocks that are not set up to make calculated and good moves. And last but not least is blaming the market for your approach. If you're trading bad, it's not the market's fault. The market is just truth. If you see that the markets are going to trade a certain way, you don't have to trade the markets. We only want to trade the markets when our edge is working and when we have an edge in the first place. These are the exact same mistakes that I made multiple times before I actually broke through to becoming a profitable trader. And if I had someone that would have told me all of this when I first started, I probably would have been profitable within a few months rather than years and years of learning all these hard lessons myself. Thank you guys for watching this video and sticking until the end. Please feel free to comment any setups you want me to review or any strategies you want me to go over within my trading, and I'll see you guys all in the next video. Bye.